Have you tried investing in passive real estate deal before and just were totally confused by all of the lingo and verbiage and jargon that was being thrown around? If that's you, you're going to be wanting to listen to today's webinar because today we are going to decode all the lingo in passive real estate investing from sponsors, operators to equity splits and more. So I am Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And this is what I love doing, is helping you figure out how to take your active income and turn it into passive income and long-term wealth. So maybe you are wanting to invest in a passive deal before, but I just stayed mildly confused about how to get started. Or you actually have invested in a deal before and went, oops, I made a mistake. It just wasn't the right fit. Or you are a seasoned investor and you simply want to sharpen your skills. Today's webinar is for you. Now, before we get started, if this is the first time you and I are meeting, again, my name is Whitney Elkins-Hutten. I've been investing in real estate since 2002, and I do it to spend more time with my crazy crew pictured here. I love spending time in the outdoors with family and friends, and just really traveling the world. But I didn't start off passive investing. I actually started off investing very actively, working 80 hours plus a week at a W-2 job. But what I did figure out how to do was take my active income from both my job and my investments, take that and put it into more levered deals. When I say levered, the things that gave me back my time, but also helped me create a return. I document my journey in my book, Money for Tomorrow, How to Build and Protect Generational Wealth, published with Bigger Pockets. But that's what I love spending my time here with you, is helping not only you repeat the same success that I've had, but also build upon it so you can get 100% control and choice on how you spend your time as well. And we can help you do that at PassiveInvesting.com. We can help you do that through equity deals like multifamily, express car wash, or in more debt-related deals that kick off predictable monthly income with our Pick Real Estate Fund. Now, I encourage everybody, don't just consume content on YouTube. Join me at PassiveInvestingWithWhitney.com. There you get access not only to see our deals, but also to future educational material that, like what you see here, but also you and I can hop on the phone one-on-one and talk through how passive real estate investing, and more importantly, what we do at PassiveInvesting.com can help you meet your goals. Now, I do this free educational webinar series to help you sharpen your skills, become a better investor. But no YouTube video, Instagram video, TikTok video should be substituted for advice. This is not tax advice, legal advice, financial advice. So make sure that you take this education and really consult your investing team before making any investment decision. Now, today's webinar, we're talking about lingo. So I want you to treat this webinar as your dictionary, your visual dictionary of all the different terms that get thrown out when it comes to passive real estate investing. Now, we're going to kick it off with some basic terms, like passive income, passive real estate, and then we're going to level it up to some high level terms. Okay, so feel free at any point in time to pause the video, digest what we just went over before you move into the next set. Okay, but again, this is like your one-stop shop for passive real estate terminology. All right, so we're going to kick it off. Passive income. This is one term that I think is completely misunderstood when it comes to passive real estate investing, because it can actually mean passive income can refer to how the income is taxed. So it can be an IRS classification, or it can actually be in terms of your time. And there's even how passive are you, how much time involvement is required of you in the deal. And there can be a whole sliding scale there, right? You could have a single family rental that is quote unquote passively taxed according to the IRS and all the different rules of accounting there. But If you are painting the walls and hiring the contractors and picking your tenants, that's very active with your time. Whereas you can actually go into larger commercial real estate deals, be it on the equity side of things or the debt side of things, which we'll define those two terms here in a second, and actually have passive income in terms of taxation, as well as be passive with your time. All right. So, which leads me to syndication. All right. Syndication just means group. Okay. We're not talking about mob bosses here from, The Wire or anything like that. We're just talking, when we talk in terms of syndication, we're talking about a group of investors pooling their resources together to jointly purchase or invest in a large real estate property. Okay. So if you ever were driving around town and you saw these big, beautiful buildings like the hotels and the apartment complexes and wondered what one person owns that, it probably not is one person. It's probably a group of investors who own that. Okay. Now, in that group, that syndication, we divided up between active roles and passive roles. Okay. So we've got our general partner, sometimes also called the operator. Okay. They are taking the active responsibility. They're finding the deal. They have the time, they have the resources to find the deal. They desire to manage the deal. They've got the team, the people, the systems, lending and credit access, and everything like that. They need capital to invest in the deal, okay, in order to take that deal down. Now, you as the investor, the limited partner, LP, you have capital to place, but you might have a higher and better use in your day job. So you're trying to figure out how to stay in your day job, but invest passively, meaning you're not swinging the hammer, you're not going out finding deals, trying to put together the financing, not trying to manage it, okay? So one group, the general partner and operator, they have all the active resources to manage the deal, find and manage the deal, but they don't have capital. But the limited partner has capital and they have no desire to actively manage the deal and put together the systems, the people, the lending and credit. So it's like a beautiful marriage here. Okay, so we've got the syndication overall group. They're broken out into active and passive roles, okay, between the general partner and the limited partners. And that just means that group, they can take down nearly anything. They can do pooled investments into real estate debt instruments like real estate notes. They can go buy an apartment building, self-storage complex, express car wash business. They can do a lot of different things. They can even like go invest in other operators' deals and preferred equity positions. Okay, so just because you hear the word syndication doesn't tell you if it's equity or debt. It just tells you it's a group of people. Then we got to figure out who the players are. Investing in passive deals, like in a syndication, it helps you create immense leverage. Now, we're not talking about the debt on the property. We're talking about you as a passive investor get to create leverage. Okay, like our guy here on the screen who's trying to lift this super heavy block. He can't do it on his own, but I bet you if he puts enough weight on the opposite end of that pole, he might be able to move that block. That's what we mean by leverage. So you get to lever the general partner's time, knowledge, and expertise, their team, their access to credit, other investor capital that comes into the deal, and more importantly, like I already mentioned, their time. Okay, the time they put into underwriting a deal, completing the due diligence on the deal, and then simply running the deal. All right. Okay, so we understand passive income. We understand the roles in a syndication. We understand leverage, why syndicated investments create immense leverage for you as the passive investor. Let's start breaking this down into some brass tacks here. Okay, now you can invest in a passive deal and you can go into the debt layers of the deal. Okay, or you can go in the equity layers of the deal. Now, if you imagine a pyramid, okay, the base of the pyramid is going to be your debt, okay? More than likely, there's going to be a bank loan. So that's going to be the senior debt. And then there's going to be a mezzanine or a second position, kind of like a home equity line of credit or a home equity loan if we're talking about your primary residence. Those are debt layers, okay? They're the lowest risk, lower return in theory. Okay. And then we flip the script. Okay. The debt layers are actually an expense to the deal. Then you have equity. Okay. Those are tends to be higher risk, higher potential return. All right. Now, we aren't talking about this in terms of capital stack. We're going to revisit this when we talk about the actual capital stack, the different layers of money in a deal. But we're talking about this in terms of where do you want to invest? Do you want to be the bank? Okay. Okay, lower potential risk. Okay, maybe slightly lower return, but lower potential risk. Okay, do you want to get a paid a dividend check or distribution every single month? Darn near almost guaranteed like a bank, or do you want to take a higher risk position and potentially get higher rewards, maybe get some tax benefits? That's going to be on the equity side of things. So that's where you, as a passive investor, as you're learning the lingo, need to understand, are you in the debt or equity positions? Now, a lot of times, passive investors go into an equity deal like a multifamily investment, meaning they're a partner, limited partner, general partner, they're a limited partner, and they think they lent money to the deal. They feel like that they are in the debt position. Okay, so this is why it's super clear that you got to get clear on what layer are you as a limited partner to this deal? Do you want to be in debt or equity? Okay. Another term, accredited investor. This is a Securities and Exchange Commission definition. Okay, the Securities and Exchange Commission, they're in the process of kind of manipulating and reorganizing their definition, but as it stands right now, they define an accredited investor as somebody who has earned income of $200,000 individually or $300,000 jointly for the past 2 years and reasonable expectations going forward. Or you are an investor who has $1 million in net worth outside of the value of your primary residence, means you take off your primary residence, do you have $1 million in net worth? Or you actually hold in good standing a Series 7, 65, or 82 license. Okay, that's kind of like taking a course in a way in order to become an accredited investor. Here's the thing, to be an accredited, some operators only work with accredited investors, and you're going to have to probably prove that you're accredited, right? Now, also, there's a sophisticated investor category. Okay, this is somebody who might have a higher net worth. Maybe they don't meet that $1 million net worth. Maybe they're at $950,000 net worth, but super close. And they have extensive knowledge and experience in business and investment. They can qualify into some deals as what we call a quote unquote sophisticated investor. Right? They just need to understand that they have to have the financial expertise to understand the deal, the risk and the value of the investment. Okay. And that what they're pursuing is high risk opportunity. Okay. These are the two different classifications. Some operators only work with accredited investors. Some operators will work with accredited and sophisticated investors. Okay. So we just need to know, all right, as you go through this process. All right, another term that you're going to run into is offering memorandum, okay? And also PPM package. Now, I put these two on the same slide because they kind of work in tandem with each other and they're often confused. Now, the offering memorandum can also be known as the OM, okay? Or if you're used to investing in businesses, the CIM, all right? They're all kind of different exchanges for each other. But this is going to be the nice, beautiful marketing document that's going to give you the objective risk and the terms of an investment. It's going to go over the financials of the investment, the biographies of the managing partners in the investment and the key players, the business plan, and a lot more. Okay. The PPM is the corresponding legal package. Okay. That's going to hold our subscription agreement, which outlines the terms and the conditions and commitments of the private investment, including outlining your investment amount and if you are an accredited investor or not. Okay. It also is going to outline any transfer restrictions, like should you invest in a deal and need to transfer ownership for whatever reason, it will be outlined in the subscription agreement. Now, also in the PPM, and I put this in quotes because a lot of people don't realize the PPM is actually 3 big parts, okay? The second part to this is the operating agreement. This outlines the terms and partnerships between the GP and LP, including the profits, distributions, and decision-making processes. Okay, and this kind of tells you how the business gets run. Okay, then you have the private placement memorandum. All right, this outlines again the terms, the risks, and the objectives of the investment. So all 3 of those pieces make up what we call the PPM package. Now, I put together this cool little chart for you so you can see, compare, contrast where to find what information. Because what I run into is a lot of time investors read that beautiful marketing offering memorandum, but then when they look at the PPM, they don't read all the legalese and they miss out on some stuff. So if you're looking for more property details, strategy, visual presentation, comparable analyses, business plan type stuff, that's going to be in the offering memorandum. If you are looking for the securities law compliance, qualification, rights and obligations, legal disclaimers, regulatory filings, all that, that's going to be in the PPM. You need both pieces to go into a deal, to have enough information to vet to go into a passive real estate deal. Okay, so if you're sitting here going, Whitney, that is a ton of information. I don't know if I ever want to read that. No, thank you. I'm going to go back to my stocks, bonds, and mutual fund investing. Here's the thing. You get that exact same thing when you invest in stocks, bonds, and mutual fund. It's called a prospectus. And that prospectus probably comes in a little book, maybe about that big, in 0.4 font, okay? Very small font and probably on the thinnest page possible, okay? And that's going to have the exact same thing, the offering memorandum and the PPM, all those Security and Exchange Commission type documentation in the prospectus. So you get the same thing. It's just I ask you, do you actually, when you invest in your stocks, bonds, and mutual fund, say you go into your VTI, Vanguard Total Stock Index Fund, do you actually read the prospectus? Most investors don't. Okay. Now I encourage you to always read your offering memorandum and your private placement memorandum. Okay. And if you invest in stocks, bonds, and mutual funds, I want you to read the prospectus. Okay. All right. We're circling back. All right. We talked a little bit about debt and equity. Pardon me. Now we're going to talk about, we talked about the debt and equity in terms of what do you want to invest in. Let's now talk about it in terms of what money is actually in the deal. So if we were taking down a multifamily building, what would be all the different layers of money that go into a deal? That's called a capital stack, okay? So our bank is probably going to be the senior debt position, all right? And then our investors that we bring into the deal are probably going to be in the preferred equity or common equity class. Now, if say we hold the deal for like 3 to 5 years and decide to refinance out some money, that would then be either we're repositioning the senior debt, or in a lot of cases, we can actually add what we call a mezzanine debt layer to extract capital from the deal. Now, when you initially invest in a deal, the capital stack should be visually represented in the offering memorandum and again described in the private placement memorandum. So you should see that in both places and they should be the same. All right. Moving on in our dictionary, cash on cash. All right. Now we're going to start getting into returns. Okay. Actual returns on a deal. Okay. Now these are forward-looking projections. Okay. We can't take them as gospel. All right. But we hope that we're getting into a deal that's underwritten really well and we can rely on this. Okay. That's everybody's goal, right? Even the operator's goal, the limited partner's goal, that's what everybody's moving towards here. Then we're going to talk about hurdles and waterfalls here in a second, but actual money that we can like look at for returns, cash on cash, that's the ratio of the annual pre-tax cash flow from a property to the total amount of cash invested in it. And it's calculated after the debt. Okay, so this will give us the cash flow invested in the deal. So if we use debt, our cash flow number actually goes up. Why? Because we have less of our own money invested in the deal. Okay, this is why a lot of people are like, hey, I want my operator to own the investment free and clear, all cash. Well, our return would go down and probably equal our cap rate, which we'll define here in a minute. Whereas we can actually boost the cash flow number if we add debt layers there and spread out our own equity risk. Okay, so capitalization rate, nice segue here. This would be the ratio used to estimate a potential return on an investment properly, calculated as the net operating income divided by the property's current market value. Okay, a lot of fancy terms there. I'm going to go back to our cash on cash deal. Let's pretend that we own the building all in cash. Okay, total current value of the building. So we're not backing out debt at all. And our annual cash flow equals our net operating income on the property. That's how we get our capitalization rate. Okay. So essentially, this would be the cash on cash return without the debt. All right. Now we're going to start pivoting into projections. Okay. We talked about actual returns. Okay. Money in theory that we are looking at and we can put it in our pocket. But now we're going to start, pivoting into assumptions that are being laid in on the deal. Now, cash on cash all depends on assumptions too. Don't get me wrong. But when we're looking at a pro forma, what we're looking at is the financial projection of a real estate's income and expenses and profitability over a set time period. Okay, so I removed the column of income and expenses, but on this particular property, we're purchasing. This is an example property. The T12 upon purchase was 2,477, right? $2,477,000. But we're estimating after 1 year of ownership with our nice new business plan that we can actually boost the income on the property in year one. And as you can see, we boost that in further years as well. And then we would look at the expenses. Okay, so the expenses were $1,472,000. We're actually dropping that from $1,406,000. And so we're creating a nice boost of return of $182,000, right? Income minus expenses. Now, these are all best guess. The T12 comes from the seller. Okay, that is what they are stating their true actual last trailing 12 of income and expenses were. Pro forma is what the operator's best guesses are for operations in 1, 2, 3, year 4, and year 5. Okay, so that's over time. Right now, we already talked about cash on cash return. Okay, but I wanted to lay it out in a different visual for you. So you can actually see how cash on cash return is projected over time. So we talked about it as far as it's a return of money, but based on our pro forma, we can project over time what the return would be to investors. Okay. Another return that we can have here is internal rate of return. Okay, now this is getting more into forward-looking projections. And it's the rate of return that would make the present value of the future cash flows plus the final market value of an investment opportunity equal to the current market price of an investment or opportunity. Whew. Okay, if you are really great in calculus, you're going to understand this equation. It's a calculus equation, but essentially it takes in, it's going to give you a return number taking into account time of the hold. Okay, so if you are looking at 2 or 3 different deals, you can take the internal rate of return and compare them to each other. You can do that. Okay, now here's the thing. You underwrite an internal rate of return. If the hold is shorter, the internal rate of return should go up, okay, not down. Right? Then we get a little bit more math here, annualized rate of return. Okay, this is the internal average annual return excluding disposition. The average return per year during the investment hold, this calculation does not include the return of invested capital. Our internal rate of return included invested capital. Annualized rate of return is assuming that your money is staying in the deal. What is your annualized return? Okay. Now, we can calculate it excluding disposition as well as including disposition. So when you're looking at an offering memorandum and the operator is saying annualized rate of return, you must know, you got to find out as an investor, are you looking at annualized rate of return, excluding your money being returned to you or including your money being returned to you? All right, equity multiple, okay? Present value of the property divided by your invested amount. Okay, essentially it's how much money an investor can make on their initial capital. So you're going to add this up between all of the cash flow you would get on a project as well as a capital gain on a project. All right, so say like you invested $100,000 in a deal and over 5 years, you're expected to get another $100,000 of cash flow and gain. Okay, your equity multiple is now 2x. You have doubled your money. All right, so those are returns. Okay, that is outside of what we call our waterfalls and hurdles. Okay, so those are, that's in theory, according to the pro forma projections, what if you invest in that deal, what you should pencil out and get. Okay, now the internal workings here actually work through waterfalls and hurdles. So let's first define what a waterfall is. Waterfall is who gets paid, who determines who, how, and when a limited partner gets paid in a passive investment. Okay, and that waterfall is going to be found in the offering memorandum as well as the private placement memorandum. Okay, then we can actually break this up further into hurdles. All right, so our preferred return, okay, this is where a lot of limited partners, when they look at a deal, their first question to me is, what is the preferred return of this deal? Okay, but a preferred return is actually not a return, it's a hurdle. So what do we mean? Preferred return is the minimum rate of return or threshold that an investment must reach before incentives are paid out to the general partnership. Okay, it is essentially the first hurdle that the general partnership has to clear before they can actually start participating in any return on the deal. Unless the PPM outlines a general partner catch-up. Okay, we're not going to go into general partner catch-ups. They're super complicated. If you are concerned that your deal has a general partner catch-up, reach out to me at passiveinvestingwithwhitney.com. Let's talk about that and talk through how that could impact you as an investor. But so we've got our preferred return. That's the first hurdle. Okay. So when you're reviewing the partnership structure, it might look like this: investor distribution of cash flow, 7% preferred return to the investor, and then it goes into a 70-30 split. So as soon as the cash flow return hits 8% or over 7.1, okay, let's just round it up. Let's call it 8%. That next 1% above 7 gets split 70% to the limited partner, 30% to the general partner. All right, so that's waterfall hurdle number 1. Okay, then after that, we can have general partner splits. All right, that's the percentage of profits that a GP is entitled to earn, incentive-free, also known as carried interest, is often negotiated because the general partner takes on additional work, such as finding, vetting the investment, managing the transaction, overseeing the ongoing investment of the deal. Okay, so what you will probably see it outlined as membership ownership you're going to see it stated like that in the offering memorandum. Okay, so this is where the project is selling, it's exiting, and then we're looking at the pile of cash and we're trying to figure out how much goes to the general partner, how much goes to the limited partner. Okay, so remember, the preferred return has to be met first. All right, then everything else would get split 70% to the limited partner, until the limited partner hits 13 internal rate of return, 13% internal rate of return. And then after 13%, the general partner gets to participate even in a higher amount. So a lot of people's heads just kind of go, okay, Whitney, this is complicated. It is and it isn't. Happy to hop on a phone call with you to talk through your investment that you're looking at. But I want you to remember this. What we're trying to do, the general partner is trying to create alignment. They're trying to give a higher return to their limited partner on the front end, okay, because they believe in the deal, and earn their return on the back end. They want to create alignment here. All right. The next term that we want to go over is sensitivity analysis. Now we're almost done here, guys. This is again, a quick fix dictionary. I have tons of other videos on our passiveinvesting.com YouTube page. So passiveinvesting.com YouTube page. Any of my boot camps would dive deeper into the various parts of how to define your own investment plan, to vetting operators, markets, and deals, tracking your investments, how to analyze market cycles. All right, that is all there for you in our boot camps. This is the last term I want to leave you with today that is super important as a passive investor that you understand. And that is when you're going into a passive real estate deal, we also want you to be looking for in the offering memorandum the sensitivity analysis. Okay, it'll look something like this that I have up here on the top of my screen. But that sensitivity analysis essentially is we want to look at it and make sure that the general partner has looked at different scenarios for exit. Okay, the sensitivity analysis, it's a method of taking into account several factors that might the investment property's total return and help you as the limited partner calculate how each change might affect your potential profit. Okay, this is super important. We want to know ahead of time that the operator has done this. Now, does it account for every black swan event like COVID or hurricanes or skyrocketed interest rates and insurances and stuff like that? No, it doesn't. But we do want to see over time that operators are adjusting their sensitivity analysis, okay, to be more conservative. So in this case, the operator here, their entry cap rate was 4.2%, but they were running numbers as if the cap rate was going up. The market was getting worse, not getting better upon exit. Okay, we want to see that. Was that enough for this particular deal? I don't know, but we want to see that trend, right? Every operator wants to exit in an amazing market, but that doesn't always happen. What happens if the market gets worse and the operator needs to exit? How does that impact your return? And that is called the sensitivity analysis. Now, again, this webinar was not meant to teach you how to use these terms, but only what are the terms, and then pique your interest a little bit more on where you need to build your skill set. Go find the appropriate bootcamp on passiveinvesting.com's YouTube page. If you want to know more, if you want to connect with me, take advantage of our one-on-one call to talk about your investing goals, see our active deals that we have open, or just accelerate your growth, reach out to me at passiveinvestingwithwhitney.com.